Have you ever wondered what it would look like if the financial system tried to warn us before it broke? Because right now it is screaming. There's a signal that has appeared before almost every economic disaster of the past century. A signal that flashed before the Great Depression, before the dot-com collapse, before the global financial crisis. And it's flashing again today. It's called the yield curve inversion, a simple yet terrifying indicator that has predicted every major recession for the last 100 years. But this time, the inversion is not normal. It's deeper, longer, and more extreme than anything we've seen before. It's showing us that what's coming might not just echo 1929 or 2008. It could be far worse, because this time the entire global economy is built on more debt, more risk, and more illusion than ever before. So stay until the end to understand what's happening. Leave a like, and let's start. To understand why this signal matters, we need to go back in time, all the way to the late 1920s. The world was dancing to the sound of endless optimism. The stock market was booming, people were buying everything on credit, and headlines were filled with words like new era and permanent prosperity. Yet quietly in the background, something shifted. In 1928, the yield curve inverted. Short-term interest rates suddenly rose above long-term ones, which basically meant that investors were demanding higher returns to lend for a few months than for several years. That's backwards. It's like charging someone more interest for a 1-month loan than for a 10-year one. And when that happens, it means money is getting tight, liquidity is drying up, and the financial system is bracing for impact. People ignored it. Stocks kept climbing for nearly 2 years after that inversion. The market gained almost 50%, while the warning light kept flashing. Everyone thought it was different this time, but by 1929, the dream ended. The Dow Jones collapsed by 80%. Unemployment soared to 24%, and an entire generation learned what happens when you ignore the signals. Fast forward to the early 2000s. The world was once again confident. The internet had changed everything. Technology stocks were soaring, and the economy looked unstoppable. But in 2000, the yield curve flipped again, and just months later, the bubble burst. Then it happened once more in 2006, this time before the housing crash. The curve inverted, warning that the financial system was under stress, but the market still rallied for another year and a half. The economy looked strong. Unemployment stayed low. The Federal Reserve kept raising rates. People said, it's not the same as before. And then in 2008, the entire world fell into chaos. Banks collapsed. Homes were lost. Trillions of dollars evaporated. And once again, that single line on a chart had predicted it all. Now look at where we are today. In August 2022, the yield curve inverted again. And it hasn't just inverted, it has plunged to depths that match, and in some ways exceed, both 1929 and 2008. It has stayed inverted for longer than anyone alive has ever seen. Yet just like before every major crash, the surface looks calm. Stocks are rallying, unemployment is near record lows, the economy still appears strong. People look at the markets and think, see? Everything's fine. But that's the same illusion we always fall for. The calm before the storm, the false confidence that comes right before the breaking point. Because when the yield curve stays inverted for this long, it's not a false signal. It's the sound of pressure building, the moment before something snaps. Back in the 1970s, yield curve inversions led to recessions almost instantly. The moment the curve flipped, the economy cracked. In 1973, oil prices exploded from $3 to $10 in just a few months. Consumers panicked, spending collapsed, and the recession hit hard and fast. The same thing happened in 1979. The signal appeared, and within months the economy was in crisis. But today, things have been strangely different. When oil prices spiked in 2022 because of the war in Ukraine, the world braced for another 1970s-style crash. And it never came. Why? Because consumers still had more than $2.5 trillion in extra savings left over from the pandemic stimulus. That cushion acted like armour, hiding the damage underneath, People kept spending, businesses kept hiring, and it looked like the economy was invincible. But those savings are disappearing now. Credit cards are full, delinquencies are rising, and that invisible shield protecting the system is fading fast. When it's gone, the real impact will begin. The danger isn't just the inversion itself, it's what it represents. Think of the yield curve as a map of time. Normally, investors expect higher returns for lending money longer because the future is uncertain. But when they start demanding higher rates for lending short term, it means they're terrified of what's right in front of them. They would rather lock up their money for 10 years than lend it for 6 months. That's how deep the fear runs, and the deeper that inversion goes, the worse the crash that tends to follow. In every single case from 1929 to 2008, the depth of the inversion predicted the depth of the recession. Shallow inversions led to mild slowdowns. Deep ones destroyed economies. Today's inversion is one of the deepest ever recorded. That's why this moment isn't like any other. Right now, investors and analysts are repeating the same lines we've heard for a century. They say, "But the system is different now. The data is strong. The models don't apply anymore." But the truth is, human nature hasn't changed. In 1929, people believed technology had made crashes impossible. In 2006, they believed housing prices could only rise. And in 2024, people believe artificial intelligence will keep the economy alive forever. Every generation has its fantasy, its reason to ignore the signal, and every time reality wins. Here's what's even more disturbing. The last time the yield curve was this inverted, the world wasn't drowning in debt like it is today. Back in 1929, household debt was small compared to now. In 2008, it was mostly housing related, but today it's everywhere. Mortgages, student loans, auto loans, credit cards, and record-breaking government deficits. The entire system is built on borrowed money, and that means when the cost of borrowing stays high, something will eventually break. It's not a question of if, only when. A family that borrows too much eventually has to stop spending. A business that refinances at double the rate eventually has to fire workers. A government that owes more than it earns has to print or default. It's math, not speculation. And the yield curve is showing us the point where that math stops working. Just a quick break, I opened a free Telegram community where I teach how to earn money with YouTube and build channels like the one you're watching. If you want to understand how to do it, there's the link below, back to before. Some people look at the markets and say, but stocks are going up, so how can we be close to a crash? The answer is simple. That's what always happens right before the fall. In 1928, the market rose for almost 2 years after the warning. In 2006, stocks hit new highs, even as the inversion deepened. The longer the delay, the bigger the eventual correction. Because the delay gives people false hope. It convinces them the risk is gone. They double down, borrow more, and fuel the very collapse that's waiting ahead. That's the psychological trap we're in right now. The longer this illusion of strength lasts, the more catastrophic the ending will be. We've already seen cracks forming. Corporate bankruptcies are rising. Consumer delinquencies are quietly increasing. The cost of financing debt has doubled for small businesses. And while headlines celebrate strong jobs data, behind the numbers, full-time employment is shrinking, while part-time and multiple job workers rise. It's the same pattern that appeared before every past crisis. Strength on paper, weakness underneath. And history tells us what comes next. The yield curve isn't just a line on a chart. It's the voice of the economy, whispering the truth before anyone wants to hear it. It's saying that something fundamental is wrong. The bond market, the most conservative, cautious part of the financial world, is preparing for pain while everyone else is pretending not to see it. And that's what makes this moment so dangerous. The calm is the illusion. The panic comes later, and it comes fast. If we trace the pattern, the 1928 inversion led to a crash about 17 months later. The 2006 inversion led to one 16 months later. And if history repeats, that window would place the danger zone right now. The setup is nearly identical. Low unemployment, high optimism, and a stock market that refuses to believe in gravity. In both of those times, people thought the inversion had failed because nothing happened right away. But when the breaking point came, it hit like an avalanche. The same could happen again, and this time the impact might be global. Because the world is now more connected, more leveraged, and more fragile than it has ever been. Banks, governments, and corporations are all tied together by the same debt web. One major default, one liquidity freeze, one unexpected event. And the shock spreads everywhere. It won't just be a stock market correction. It could be a structural reset of how money itself works. And the yield curve, quietly inverted, is already foreshadowing that transformation. What happens next will depend on how long this illusion of strength lasts. The longer it holds, the more violent the release will be. History has never seen a soft landing from a yield curve inversion this deep. Never. And that's why pretending it's different now is perhaps the greatest mistake of all. The deeper the silence, the louder the crash. So what can we do? The answer is not fear. It's awareness. The yield curve doesn't tell us to panic. It tells us to prepare, to see through the illusion before everyone else does. Because when the system finally gives in, those who understand the signal will be ready. They won't be the ones trapped in denial. They'll be the ones standing clear of the wreckage, while the rest of the world wonders how it all happened so fast. What's coming is not just another recession. It's the unwinding of years of excess, leverage, and false confidence. It will shake governments, companies, and investors who thought they could outsmart history. But in every collapse, there's also rebirth. The Great Depression eventually built the modern financial system. The 2008 crisis reshaped global banking. And whatever comes next will do the same. It will hurt, yes, but it will also clear what was rotten. The yield curve is warning us, just like it always has. It's saying the system has gone too far, that pressure is reaching its limit, and that pretending otherwise won't change what's coming. Every calm before a storm feels peaceful until the first thunder cracks. And when it does, people say they never saw it coming, even though the signal was right there all along. This time you can see it, you can feel it. The yield curve doesn't lie. What's coming will not just repeat history, it may rewrite it entirely. And nobody talks about it. Like nobody is talking about the fact you're not subscribed yet. Smash that subscribe and like button, let me know your thoughts in the comments. And I also want to remind you that if you want to build a YouTube channel like the one you're watching now and make money from it, I opened a free Telegram community with the link below. See you there or in the next video. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.